in the chat. How's everyone doing today? Thank you for that, Leon. Awesome session.
You're welcome. You're welcome.
And just bear with me a moment, ladies and gents, while I just get up the old screens. Same etiquette applies. Please keep your mics off and your video switched off as well. If you've got any questions, stick them in the chat at the end of the session. All right, just bear with me 1 second, guys. I'm just going to have to share the old screen. Let me know when you can see the old screen. Adjust the old PowerPoint. And you should be able to see my ugly mush. Let me know if you can. That will be awesome. I just got to readjust all the screens and whatnot. Yeah, you guys see the my slide okay? Jolly good, jolly good. Great, great, great. Okay, so thank you very much, everyone, for attending today's call. I hope you've learned something of value so far. I'm sure you have. What Leon has to teach is foundationally and structurally very important to your trading career, essentially. These are all things that I massively encourage you master, along with the stuff that we're going to talk about with you shortly. You need that fundamental bias to be able to formulate an idea. It's really interesting as well that Leon mentioned, don't just take the 2 negative GDP quarters as gospel for a technical recession. And actually, they're making it a lot harder for you to understand when a recession is happening and isn't happening. Just listening to the Bank of England governor this afternoon, and he was claiming the UK was in recession in the summer. There's a news to the rest of the world, right? No one else knew that from if you were going by the technical recession to negative quarters of GDP. So very interesting and absolutely something that you should bolt on as a must for your trading. What I'm going to talk to you about today is once you've got a handle on generating an idea, coming up with a thesis for a trade, just quickly, one really great shortcut that you can learn. It's really interesting and quite good fun as well. Is buy yourself a Bloomberg subscription, just the Bobby Basic one. I think you can get it for like a few dollars a month for, I think, the first 3 months or something, and then it's like $10 a month after that, something like that. And just get used to reading articles and as Leon said, ruminate and take your time, and you can pick some real gems out of those articles that for those of you who find perhaps the technical uncovering of this information quite a challenge. That's one way that you can actually shortcut some of these ideas and essentially let some well-paid analysts somewhere do the hard work for you. But anyway, I digress. You definitely want to have that fundamental foundation. And then what that allows you to do is come into the market with an idea, a thesis, something you generated yourself, and then you can bolt on to that the ideas that essentially, I'm going to talk about today, or some other ideas that you may find resonates with you. And then ultimately what you've got at that point is an extremely robust trading strategy. The things I'm going to talk to you about now, in my opinion, coupled with fundamental analysis and what Leon teaches, is in my opinion, as much as you can reasonably expect to achieve from a knowledge base standpoint as a retail trader. Okay, failing, having a relationship, which is what happened in this case with this information, or knowing someone with some inside information, you're not going to come across any higher level as a retail trader, any higher level knowledge. So it's about as robust as it can get. And why that's important is it may seem like a kind of a moot point, but it's vitally important, because in trading there is so much information out there that you constantly are being attracted by the new shiny thing, the new indicator, the new buzzword, the smart money this, the order blocks that, the market maker that. It's just, you just do not know how to focus. What's wonderful about having that robust strategy in front of you, which is what you are going to have the chance to do today, it allows you to drop everything else and just focus on understanding fundamentals, so you can generate that idea, and then being able to interact with the market with that, in this case, with the business model of the liquidity providers. All right, so without further ado, let's get cracking. Yeah, won't bore you with the details, but head coach at the Underground Trading Alliance. That's just a small group of traders who trade these ideas with me on a daily and weekly basis. As Leon said, I taught Leon how to trade many years ago. He's one of my successful students and has gone on since then to be very successful. Me, 20 years trading veteran, and some might say an expert of all things market manipulation. I was also the former trading coach at the Lex Van Dam Trading Academy. Lex Van Dam was the former head of FX trading for Goldman Sachs in New York, and also created the what was like a bit of a documentary, $1 Million Traders. You can watch it on YouTube, where he put up $1 million of his own money and taught traders how to trade, proving that anyone could learn to trade, and actually outperformed the hedge fund index during that period with a group of novices. Interestingly, that was in the last crash as well, so given where we are today. But yeah, so that's me. All right, let's get cracking. So what are we going to talk about today? Well, I'm going to expose you to the actual. So I can't expose you to everything today, obviously, but I'm going to expose you to the actual business model of the large liquidity providers, the market makers. And as Leon referred to before, this is not what you've heard online. This is not Steve Marino. This is not 3 pushes into your mail or any of that bullshit. It's the actual business model. The information like this doesn't come into the retail sphere, and the only reason it did was through a retirement and a mistake on the company's behalf, who employed my friend who was at the CME for 30 years, and making markets for the CME, I should say. And there was essentially an oversight with regards to non-disclosure agreements, and our friendship meant that when he retired, he trusted me to take this information and share it with whoever I came across who wanted to learn it. So it's not what people think it is, and the reason it doesn't get into the zeitgeist in the retail space is, number one, I don't have a particularly big following, so it won't have the chance to do that. And number two, people who are market making on a daily basis are bound over by non-disclosure agreements, and ultimately that means that they can't say anything, and generally speaking, well, to be perfectly blunt, don't want to say anything. They're too busy making tons of money to give a fuck about people like you. All right, so apologies for any swearing. There will be the odd swear word potentially, so yeah, just watch your volume when you speak, as if there's children around. I should have said that before, but I apologize. Okay, guys, so the market is an auction. What Leon was referring to earlier with regards to value, that's very much a part of the auction market theory. There are lots and lots of different ways to describe the market. Leon mentioned a couple: Elliott wave or Gann theory. There's a zillion different ways of doing it, but none of them are actually true. The market is an auction, full stop. Okay. And when you actually realize what it is that you're interacting with, just like a car auction in this example, or just like any type of auction, a house auction, buying and selling property, whatever it might be, when you understand what it is that you're interacting with, it gives you, for a change, a chance to understand it and therefore master it. Okay. And you can drop all the rest of the stuff and just focus on what it actually is. Strangely, this is one of the only environments in the world that I can think of where there's lots of different things to describe things in the market, strategies in the market, and most of it is wrong, which means that you can spend an awful lot of time slash waste an awful lot of time, typically add into the mix an awful lot of money, and not get anywhere because you are actually treating something incorrectly. You can't master something if you don't know what it is. Okay. All right. So just bear that in mind, and we'll come back to the old auction in just a moment. Right. So can you see this screen, guys? Just quickly, just want to check you're coming along with me. The markets are extremely illiquid animals. Can you see that? All right. Give me a quick yes and say, oh, jolly good. Thanks for that. All right, cool. So markets are constantly fighting for liquidity. A lot of people don't really give that much thought or are really aware of it. And it's the actual reason why market makers are present and have always been present. They've been making markets as early back as the earliest times it was recorded was in the 1800s, and they're still making markets very much so today, and will continue to always make markets. It's not some type of conspiracy thing like, oh, the market maker just nicked my stop loss. So, they may well have taken your stop loss and it may well have been intentional, but there's no conspiracy. They are there doing a job. And we'll get into that also a little bit later on. Market makers, again, have always been around. Market makers will continue to be around, and they are heavily, heavily integrated into that auction structure. And just to give you some sort of context for that, some sense of that, market makers are there to provide liquidity for the auctioneer. Now, who's the auctioneer? It's the person who owns the business, right? And in the case of the markets, that's the exchange. Now, if you trade in CFDs, it's your broker. Excuse me. Now, the exchange, if you think of the exchange, their product, what is the product that they are selling? What is it that they are providing as a service? And it's so that people can transact and interact with the auction process and buy and sell X in whatever quantity at any and all times at any and all price. That's the product. The issue, however, is that that's not possible without the help of a market maker / market makers, because the market is very illiquid. So let me just give you a sense of like one end of the scale to the other. If you think penny stocks, that's the most illiquid version of what we do, right? And it's not, why do like more people not trade penny stocks? It's not because anyone has anything against penny stocks. it's because you can't do anything there in any size, right? It's completely illiquid. You can't get in, you can't get out. So it's just very, very difficult / impossible, and that is in essence the absolute quintessential example of an illiquid market versus a liquid market that is fighting illiquidity all the time. You'd be surprised, and by the time this presentation's over, you'll be able to actually see for yourself just how illiquid markets are. And this is the requirement why market makers exist. So market makers and the exchange are heavily, heavily integrated to the extent where the exchange pay the market makers on a monthly basis something called a stipend, which is essentially it's a retainer. And that money does things like it kind of hedges a little bit of exposure for the market making business as a whole, puts the lights on, pays some basic salaries, pays the rent, etc., and is a profit center for them. It's not the only one, there are several. But the exchange do that. They pay the market makers. So when people think that there's this conspiracy and market makers are these shadowy entities, they are shadowy in the sense that they're not interested in being seen or known publicly, but it's not they are in bed completely with the exchanges. Following on from that, they also share security. They are completely embedded in terms of security and technology. So it is they're actually sharing those things. So it's a very close relationship. Market makers are ECNs. So if you think that you're trying to sort of avoid the dealing desk and you're trying to avoid the market maker because you've heard that somewhere on Forex Factory or wherever, and you've got yourself an ECN broker, nice try, but unfortunately you've still got yourself a market maker. It makes absolutely no difference. It's a complete sleight of hand. People think that it means that they're somehow not at the behest of the market maker. They are the market maker. And just to put this into context so you can visualize this properly, if you've got a broker, let's say this is your broker that you use on a daily basis. Let's just draw a little circle on here. So here's your broker. Now, if you could just mute yourself, that would be awesome. Yeah. So if you've got yourself a CFD broker, and that broker's, let's say, got 10,000 customers or 5,000 customers or whatever, then here you are, and this is you in that company, and it's ECN. You want to avoid the market maker, or so you think. And here's all the customers, and this makes up that broker, right? That's that broker's entire customer base. Do you know who the other person is? You know the person who owns that company? That's the market maker. So it's a synthetic market. It's not even real. It's made up of you and the market maker copying or attempting to copy the actual market, then price it accordingly. So you are at the what's the word I'm looking for? Fill in the blanks, to the market maker. Brain phrase. Yeah. So yeah, that's if you trade CFDs, that's the reality of it. Market makers don't control the market, so you might be interested to know that. A lot of people think that the market makers are, control the market. Again, the shadowy cabal of conspiracy theories that fly around. They don't control the market, but they heavily influence it for sure. Nobody controls the market, and he's one of the sort of the beautiful, elegant things to consider about this information. When I said earlier about the fact that when you've got fundamental analysis and you've got something like the actual business model of the market makers, but you bolt those two things on. The other thing that is absolutely wonderful that comes from understanding this information is that you realize that no one does control the market. Why that's important is because you can actually freely release yourself from the shackles of constantly believing someone has the upper hand or someone knows something you don't. When you know the business model of market maker, that is about as far as you can take it. And when you realize that even market makers don't control the market, that allows you to look at the market with a different set of eyes. And I'll come back to that point because it's quite nuanced and quite tricky to explain without showing you a chart, but I'll come back to that. All right, cool. Makes sense, guys? Just let me know if I'm making sense and if we're okay to continue. Yeah, jolly good. All right, so let's get into it. So here's the exciting stuff. Market makers must first be in a drawdown prior to making money. Just let that sink in for a moment, right? Read it and let it sink in. Market makers must first be in a drawdown or go into a drawdown prior to making money. Okay, hugely important for you to understand that, and I'll show you what that looks like as we go on. Okay. All right, so just quickly, we're going to go into sort of their role in certain market environments, what they're doing during these periods, and I just want to ask you guys, what sort of name would you give to this market, this drawing that I've put up? What would you say that market represents? What's the state of that market, would you say? Andreas, yeah, ranging market. Someone says it's an auction. Channel, says song. Yeah, right. So sideways, dead, range bound, consolidation. That's another typical one. Ranging, Moses. Yeah, exactly. And when I said earlier about the market is full of words to it or phrases to explain stuff, and it's wrong. It's not just marketing. It's just factually incorrect. A lot of the time. The problem with that is if you think that's a range, Moses, or you think that's a channel song, what you're never going to do is you're never going to interact with it properly. So it's like it's the most insidious thing of all in the markets is that there's lots and lots of things that have names, and everyone believes that these things have names. Like I didn't script that. It was obviously fairly obvious what was going to come back, right? Because everyone thinks the same thing, but it's wrong. And why that's important is you can't understand something if you don't know what it is in the first place. It'd be a bit like having a pet dog and treating it like it was a chicken, right? So it's not gonna react the same way as it should, right? It's gonna be like, why, dude, why am I eating birdseed? Where's me pedigree chum, right? Piece of steak or whatever dogs eat, right? You can't treat it correctly. So if you think that's a ranging market, you're never going to interact with it correctly. What that market is it is not maybe, not some of the time, not just because Mark says so. Value. Okay. Now then, during value, when prices, someone mentioned the auction. What's happening during a period of value, where value gets established? There is an auction going on, and the best way to think about this, I know the auction's going on all the time. It's not just going on in fair value. The auction process is happening, or it's happening until it's not, and that's literally what the market makers, that's part of their mandated role to deal with when it's not auctioning correctly. But when it's auctioning correctly, or specifically when it's auctioning during a period of value gets established. The best way to think about this is just two people, right, that are buying and selling something amongst themselves, and they're basically coming to an agreement on the price of it, right, the value of it. So it could be anything. It could be a dog, a chicken. It could be whatever, a barrel of oil, right? And they're just agreeing that this is an acceptable price to pay. The seller's got a mandate; they want to sell. They said, a dog, let's say, and the buyer wants to buy the dog, and they agree, shake hands, and do business. Now, of course, there's not just one person selling. There's not just one person buying. So what tends to happen typically in a situation like this, not always, but typically, there's obviously lots and lots of people doing business at this price, at this value for the said item. And what that creates is essentially a very stable market. Now, does anyone have any ideas why a stable market might be advantageous if you're a large trader? Or a large trader on behalf of a large company, or whatever it might be, something large. Well, what's the advantage of that? Moses, yeah, well done. I won't read the answer out just yet, so give others a chance. But yeah, that's correct. Anyone else? What's the advantage of? So when you say a sideways market or the market's consolidate, it doesn't explain what it is, and therefore you can't master something you don't know what it is. You can't come to grips with it and treat it correctly. They can have a stable price. Yeah, exactly. Trading. Yeah, the MK. Exactly that. Moses, 100%. It represents lots of liquidity. It's not always, but typically a market that is in value is extremely liquid. So just going back to the reason why market makers pretty much exist is the market becomes illiquid. They're there to try and stop that occurrence. But there are periods where the market is very liquid, and it's typically during a period of value where you are auctioning and people are agreeing on the price of something. And the reason that is advantageous to large trading entities is because there's a stability to price. So just think this through. If you've got to buy a shit ton of whatever it might be, right? Barrels of oil, whatever it is, gold. You want to essentially transact as close to that price point as possible. Would you agree? Like as close to zero as possible. You don't want it to fluctuate, because if it does, you're going to end up doing what? What's it going to end up doing? Yeah, it's not about profit. It's about, in this context, it's about costing you more. Exactly. Right? If prices are moving dramatically away from the said price, whatever it might be, right? X, fill in the blanks, doesn't matter what it is. You are going to end up it's going to end up costing you more potentially to buy and sell, and that's not what you want to do. You want to get it as close to the value as you possibly can. And if you are trading in huge size, why do you need the market to be liquid? What is the necessity for the market to be very liquid, or as liquid as it can be, when you are transacting in big size? What's the point? Yeah, because if it's not liquid, the market will move quickly away from the price that you're willing to do business at. Right? It becomes illiquid, and therefore price will jump. It'll reprice. It'll say you won't get filled on your orders. Exactly. Makes sense. So this is why. So, just going back, you just thought this was consolidation a minute ago. It's far more important than that, right? This is where massive transactions can transact close to that price point as humanly possible, so that everyone's a winner, everyone's doing business at that price point. Admittedly, not everybody will think this is an area of value where they want to do business, but the market is full of highly motivated people that have mandates, they've got deadlines, they've got shit to build, stuff that needs to get done. Whoever those people are in that moment, they are there and they are doing business, and they're doing it in a market that is advantageous to them being able to transact efficiently to get the business done, and then bang, they're off going about the day. Right? Does that make sense, guys? It can be highly liquid. I say it can be because there are occasions where you would look at a market environment like this, and actually, you might, on face value, think of it as highly liquid, and actually it's not. You need to know the difference between looking at an area of value that is liquid versus one that isn't. It's massively important that you understand that. Make sense, gents, ladies and gents? Let me know if this all makes sense. Are we having fun? If you're having fun, you need to get out more. Oh, cool. It's fun for us, isn't it? Us sad traders. Okay, so all right. So what's a market maker doing in here? So we've established that there's lots of people transacting here, and because of that, that causes the market to become illiquid, liquid, right? It's because of that. Yeah. Now, it's not the only reason. The other reason why you have bags of liquidity in a moment like this is because market makers are present. all of them. So the amount of market makers is never knowable. You'll never know it. I'll never know it. You can, just so let's just say there's 8. Who cares? Doesn't matter. The reality is, however many there are in that market, and typically they tend to specialize.